The housing crisis, I mean, it can feel completely impossible to solve, right? But what if a pretty radical idea could unlock billions of dollars to tackle it? Today, we're going to dig into a bold proposal that could turn our biggest financial institutions into affordable housing developers. And it all kicks off with one single question. Think about that for a second. What if the answer was right there, inside our banks? The idea is to tap into the massive capital of bank holding companies, the giant parent corporations that own banks. But to do that, we'd have to rethink a really fundamental rule in American finance, that old wall separating banking from commerce. And right there, that's the heart of the issue we're looking at today. This isn't just about finding more money. It's about doing it without, accidentally triggering another financial crisis. So the big question is, how could you possibly design a system that unleashes all that power for good while keeping those huge risks contained? To figure that out, we first have to get really clear on what those risks are. That wall between banking and commerce, it was built for a reason. So any serious proposal has to tackle the dangers it was meant to prevent. Let's break them down. So the dangers really fall into three main buckets. You've got financial risk, which is a threat to the banking system itself. Then there's market risk, the chance that a bank could get an unfair leg up on the competition. And finally, and this one might be the most important, there's mission risk, the very real danger that the whole social purpose of this thing just gets lost along the way. So let's start with the money. Real estate development is not a smooth ride. It's a total roller coaster. You've got market cycles, unexpected construction delays, costs that go through the roof, all of it. So if a bank's development project goes belly up, you have to be absolutely sure it doesn't drag the bank, and more importantly, its depositors' money down with it. Then you've got the market risk. Just imagine a bank that's also a developer. Is it going to give its own construction projects better loan terms than it gives to a competitor? You bet it could. And that could totally stifle competition and basically push smaller independent builders right out of the picture. And that brings us to the sneakiest but maybe the most critical danger of all, mission drift. We have to remember, bank holding companies are for-profit businesses. The big worry is that they'll start a project talking all about affordability, but then, slowly, the goal shifts to maximizing profit, and you end up with housing that doesn't actually help the people who need it most. Okay, so with all those pretty serious risks laid out, you've got to be asking, how could this possibly work? Well, the proposed solution isn't to just tear down that wall between banking and commerce. It's to engineer a very, very strong and secure gate through it. And this is the key idea right here. You isolate the risk. You let the development happen, but you keep it completely cordoned off from the core banking operations, the part that protects our savings. You don't mix them together. You create a super controlled, regulated connection between them. This quote right here is the absolute linchpin of the whole financial safety plan. It says the bank has to use a separate, adequately capitalized subsidiary. What does that mean in plain English? The bank has to set up a totally separate company just for its development projects, and that new company has to have its own money and stand on its own 2 feet, which protects the main bank from all its risks. So how does that actually work? Well, first, any cash the parent bank puts into this new company gets subtracted from its own safety cushion, its regulatory capital. Second, they are legally separate entities. That means if the subsidiary fails, its debts don't become the bank's problem. And third, the bank has to have concrete plans in place to manage its own risks and keep itself walled off from what its subsidiary is doing. And that's not all. On top of that, regulators would add even more layers of protection. The new development company itself would have to hold more capital than a normal business. It'd get put through intense stress tests to see if it could survive a market crash. And the whole thing would kick off with small pilot programs to test the waters before even thinking about scaling up. So what about that market risk, the unfair advantage? The answer there is tough regulation. Really strict anti-tying rules would make it illegal for a bank to, say, force a borrower to use its development company. Lending decisions would have to stay completely impartial. Okay, so we've put a firewall around the financial risk, and we've got rules for market fairness, but what about mission drift? How in the world do you guarantee that these new buildings will actually be affordable for the people who really need them? Well, this is where we can actually look at a model that's been proven to work. The key isn't to just rely on good intentions. It's to build strict, non-negotiable affordability requirements right into the law, using a blueprint that's been working for decades, Washington, D.C.'s Housing Production Trust Fund. Just look at these numbers. This model leaves absolutely nothing to chance. It mandates that a full half of its funds, 50%, must go to help the most vulnerable households, the ones earning less than 30% of the area median income. These are not suggestions. They are hard, enforceable legal requirements. And how long do these places have to stay affordable? For 40 years. That is a generational commitment. It's not some short-term fix. And they make this happen with something called recorded covenants. Think of it like this. It's a legally binding promise that gets attached to the property's deed itself. It's written into the DNA of the building. So even if the building gets sold, the new owner is still legally required to keep those units affordable for the full 40 years for rentals, or 15 years for homes people can buy. And the model is just so well thought out. It has specific rules to make sure rental housing gets built, an oversight board to keep everyone accountable, flexible financing tools to make the projects actually work financially, and even a scoring system to make sure new buildings fit what the city really needs, like more family-sized apartments or housing near public transit. So, after going through all those massive risks and the really intricate safeguards designed to counter them, what's the big picture? What should we take away from all this? At the end of the day, you can't eliminate risk entirely from an ambitious plan like this. It's not about creating a system with zero risk. It's about designing a smarter system, one that cleverly walls off the financial danger while legally locking in the social mission. It's a calculated balance, really, trying to harness private money for the public good. And that kind of leaves us with one last really interesting question to chew on. If a model like this could be designed to tackle the housing crisis, what else could it be used for? Fighting climate change? Building new infrastructure? It really makes you wonder what else is possible if we start thinking more creatively about how to use the power of finance to make progress. Thanks so much for watching.